This conference will now be recorded.
Good evening, ladies and gentlemen. This is Clueless 8 Trading Frank. It's 8:38 p.m. Eastern Standard Time on the 25th of March, 2019. We only have till the end of the week, the 29th of March, to end this very turbulent quarter, the first quarter of 2019. Overall, it's been a solid quarter, and I believe that they will try to finish it that way too. On that note, full disclosure, these webinars and strategic sessions are purely for financial education, not for any solicitation or advice. Session will be recorded, uploaded to the Google YouTube channel for free viewing by all other members, free trial subscribers, and anyone out there with internet connection. So certainly spread the word. And again, a quick friendly reminder to follow us on our Clueless 8 Trading Instagram channel, which has been growing rather nicely. We should be crossing over 500 followers. For a dry investment type of Instagram, which is only charts and options tables, options performance ROI, 500 is a pretty decent number, and we expect to get into the thousands with some hard work on my end and some help and cooperation from all my members. Do pass this word around on that too. On that note, let us begin. We will, as we normally do, give you a full comprehensive but concise overview of what exactly is going on, so no one remains, in the literal sense, clueless or completely ignorant of what's happening in the markets. And then we'll go through some technicals when we have time. We'll certainly look at some charts. I'd certainly like to look at some stock charts, certainly. And then we'll wrap it up. We'll certainly, I always entertain questions from my members, great members that you guys all are, and feel free to ask that during the Q&A session. So let us begin. First and foremost, we are what we are going through, believe it or not, is actually pretty normal. And it seems so dramatic during the day. You know, markets up 100, down 100, goes up 50, down 40. But in reality, the markets are basically just trading just the way it always has, and more so on certain times or I shouldn't say certain times of the year, but more so at certain levels in the market, the machines take over completely. And I show them I show them to the highest degree of accuracy and predictive and predictive functions, if you want to put it that way, as much as possible. And what is this? Okay. And my 15-minute charts, my 1-hour charts, all through the day, keep people grounded as to what is going on. So no one is left there saying, hey, what's the big news? Well, you're always connected. The real-time Twitter feed is real-time in the truest sense, and I'm sure that all of you take full advantage of that. Even people who are extremely busy during the day with their own businesses can click in, scroll through, and have a full understanding of what is happening in the markets that particular day. All right. So let me start off by talking about some broader points as we kind of flip around the screen a little bit, look at some charts. Is that today was really about Apple. And Apple was driving the markets up and down. And at the end of the day, it ended down only $2. If you just want to look at it from a stock standpoint, it just ended down $2. It was down 1%. Yeah, at one point it was down $4. At one point it was, I don't think it was up at all today. But yeah, I think it was up early in the daytime. Let me just consult my charts here. At 9 a.m., the stock started. 8 a.m., the stock was actually up. At 9 a.m., it started a little bit down. It was up in that 192 range. And then it just chopped around. And the end of the day, down 2. Boeing was very strong. So it truly, today was all about Apple. It was there was obviously very positive news from the political side that the special counsel exonerated President Trump. Any sitting president, if it's criminally indicted, doesn't matter what political affiliation, is not something that the market likes. Yeah, the market will recover from that, but no one really liked to hear that there was some criminal indictments against President Trump. And again, it's nothing to do with politics. Just overall, I'm looking at it from a market standpoint. So that was good news. And initially the futures had ticked up about 7 to 10 points right after the news came out last night, right before the Globex futures started trading at 6 p.m. Sunday evening. But then it gave in. A lot of the pressure is came from Asia. Asia sold off very large, so there was some leftover selling. Remember, these are markets; these are global markets. U.S. markets are global, and they're all interconnected. So I'm sure there had to be some overflow selling that hit our markets and needed to be taken care of during the day. There's a lot of undercurrents in the market that happen, ladies and gentlemen, which I can sit here and explain because a lot of it, I mean, I know, but I don't know the specific. Global inflows of money back and forth all around the world on a 24/7 basis, trading futures, trading our stocks in Germany, some of the big stocks, obviously, the Apples and then the Googles and stuff like that. They trade on the German exchange too, cross exchanges. Trading in China. China was down quite a bit too. For no reason. There's a lot of positive developments going on the U.S. trade front. Lighthouser and Mnuchin left for China, leaving for China on Thursday for a one-day visit, and then a couple of days later, Chinese Vice Premier Li Kua, I still can't pronounce his name right. Li Hua, I think his last name is Hua. Very smart gentleman. He's going to be back here again. So there's a lot of back and forth. So overall, under normal circumstances, which the markets are never normal, it'll be considered to be quite positive. If a sitting president not getting any blowback, that's the no foreign Russian collusion was determined, all that stuff, no indictments, it would be extremely positive. Then the U.S.-China trade overall going, back and forth, but still going and moving along as it should be. That's positive. But there's a lot of currents, with technical undercurrents. One of them has to do with the fact that the 10-year government bond is a 10-year government bond yield. Sorry, 10-year government bond yield. Remember, there's an yield and a price, right? So the 10-year government bond yield is totally collapsing. So let's take a look at that. And this has a major effect on markets because maybe I can open up another screen here. Yeah, because when the bonds are collapsing like that, there's a lot of underlying trades, more derivative type of trades that are unwinding. Bond deals, which are measured in the 10-year government bond yield, which is overall benchmark. Look at this chart. I mean, just look at this chart. The 10-year government bond deal, just since the 1st of March, has collapsed from 2.75% down to 2.377%. Take a look at this, which is great for the housing market. So it's a net positive if you really think about it. But it's not necessarily positive for funds who are betting against, because government bond yields are falling, government bond prices are rising. In other words, it's a safety trade. A lot of money coming into the government bonds, raising their prices and dropping their yields. So it's almost like that's what's known as risk off. You're sucking money out of the equities or stocks, which is risk on. That's how it's called. Stocks are known as risk assets, and so it's driving up the price of government bonds as a safety haven, because government bonds are the safest instruments in the world, and that's pushing down government interest rates, which are known as yields. So if you drop from, let's say stock drops from, think about it like that, and I'm just going to look at it from the beginning of March. How about that? And this should say something. It's not whether they're falling or rising. Remember, the markets used to freak out when government bond yields were rising. It was called a rate tantrum. Now it's just the opposite of it, because there's a yield inversion going on. Okay, yield curve inversion. I think I put out an article on that. Do Google and read up on it. It's quite simple. It's basically saying that the longer-term government bonds are falling below shorter-term government bonds. It should be just be the opposite. Longer-term, if you're going to put a lot of money in buying bonds and sitting on it, you want to get paid more, right? You got to pay more interest rate for holding it for 10 years instead of 3 months. So the 3 months should be lower rates or yields versus the 10-year, because you got to lock in your money for 10 years. Not that you can sell it during the way, but if you sell it, you'll be held hostage to whatever the bond prices are. But if you hold it for 10 years, you get the yield, the full interest rates compounded on that for a 10-year period. So the 10-year government bond yield, which is currently running at 2.42%, that's what it closed at, not 24.2, just to move the decimal once to the left, is obviously. So 2.42%. So if you hold it for 10 years, you get 2.44% on your money on a yearly basis. So that should generally be higher, much higher than a 3-month yield on or a 3-year paper, because that's much shorter term. But that has gone now upside down. Now, part of the reason they said that the yield curve inversion signals a recession. Well, if you really study historical macroeconomics, you'll see not necessarily. Not necessarily. I'm not going to get into that theoretical debate on that. This is not a Harvard or Princeton economics class, but it's not really, and you've heard some of these guys talk about it on TV, and you can read up on your own. No, it doesn't always mean that. One of the reasons this is happening is because the real reason why the markets fell, as I explained to you guys through my Twitter feed on Friday, was that government manufacturing data and economic data collapsed, and really was bad, and that's not good, because Eurozone is a major exporting zone globally, both to Asia and to us. So Germany, the strongest economy in Europe, is slowing down that hard, going into a contractionary phase. Then what's it going to do overall for the global economy? We're going to get hit. You just can't independently, sometimes President Trump says, hey, we're doing so strong, they're all weak. Well, in the long run, what happens, that he's saying it from a political standpoint, I understand what he's saying, but from a real economic standpoint, it doesn't work like that. This is a global economy. 70% of S&P 500 companies make their profits selling to overseas customers. So if the overseas customers don't have, if their economies are weakening hard and their exports are weakening hard, how are they going to pay for all the goods that they buy from us? So it's not true that we can independently remain strong, the United States, because 70% of our GDP, 70% of our largest companies in the United States make their money by selling to foreigners. So if they can't buy, how can we stay strong? So so bottom line is that it needs to be where the global economy is doing well, we are doing well, and it is that's just the way it works. All right, it's a symbiotic relationship. So saying all that, when you see bond deals in Germany collapse and they went below zero at one point, zero, that means they are paying you to keep your money. You're paying them to keep your money. So you're putting in $100 in the bank. You're saying, I'm going to pay you 10 cents on every on $100, a dollar. I'm just exaggerating, but still, I'm going to pay you 10 cents for every $100. But please let me keep money in the bank. It should be the opposite. The bank should give you an interest, right? So the fear is that the yield conversion leads to a recession, and that obviously scared the living daylights of the markets. The algos go to work, but primarily this is a European issue. And that caused our bond market to also go into a mini depression, as in the rates collapsing, causing a flight of money moving out of equities, which are risk assets, into the safe haven of government bonds, where prices rose. Bond prices rose. I'm going to put B. Okay. Bond prices rose and bond yields collapsed. So market always takes a little bit of time to come back to its senses. In the meantime, we as tactical traders, we see the levels, we try to trade the levels. We're going to talk about that in the next couple of minutes. So saying all that, let's take a look at a percentage basis what this drop is all about. If something falls from 2.7, bear with me, falls from 2.76 down to 2.36, that's where it dropped to, or 2.37, that's where it dropped to. Remember, the decimals have to move, shift once to the 1 decimal point to the left. So 2.76 minus 2.38, rounding it up, is a drop of yields drop by 0.38. So you divide the 0.38 just to get a percentage number by 2.76. This drop basically equals, and imagine, some people have a difficult time like figuring out the percentage, but look at it from a stock standpoint. If a stock is at, let's say, 2.76, and then it drops to some of these, the small spec stocks that we play, and they drop to 2.37, That means the stock has dropped 13.8%. So bond yields basically dropped 13.8%, and from here dropped just from last week. The bond yields have dropped about 7% just in the last couple of days. But in total, bond yields have dropped 13.8%. So it sends shockwaves through the market, right? Not everything drops at the same time. We have had big, powerful days, but it does put pressure. And after what happened on Friday with the German economic numbers and stuff, today was kind of blowback on that. Yet the markets ended positive. You could feel the pressure on the markets, but the market ended positive, with lots of our stocks from intraday reversals moved up very nicely. But net net, the markets were under pressure. So that's, just in a nutshell, just want to explain to you the real reasons where the pressure is coming from. Is everyone clear on this? Yes?
Yes.
Okay, sounds good. Now, because you have to know these things, otherwise it's like, wow, there's good news coming out in there. Why isn't the stock going higher? That's what an average RET trader, retail emotional trader, is like, oh my God, the stock should go up. The news is good. Well, if there's a large sell program coming out of Europe, coming out of the US, it doesn't matter what stock you're in. It's going to be pushed back, especially name brand stock, which move with the S&P 500. Yet one of our biggest consistent winners on a swing and the day trading basis, Boeing, was up a lot today and will be up more tomorrow from the likes of it. All right. But that's all about tactical trading. This is the broader macroeconomic reasons why the markets were down. All right, enough of that. Who wants economic lessons? We want to talk about stocks. So saying all that, let's take a, so we have that. Oh, forgot the biggest thing. This Brexit fiasco drama has now been taken over. I showed the last headline that I tweeted out a couple of hours ago by the Parliament. And the Parliament is going to have a vote on Wednesday whether to completely take Theresa May's control over the Brexit process out of her hands. So far, they have technically taken it out of her hands. That net is market positive, because any delay in Brexit or a complete delay or a non-hard Brexit, just like say, okay, I'm done with you guys, I'm walking out, will create havoc in the European markets, in the Eurozone, and which will overflow into us, and you guys are not going to like it short term. Okay, so we want Brexit to be an orderly process or delayed. So now it looks like it is going to be a delay process that the Parliament, now that the MPs, the members of Parliament on both parties, have now decided that that's they want to do. They don't want to give, they want to wrest control of the Brexit process away from Theresa May. So overall, the markets kind of like that, because she couldn't make headway on what was going on. Not always her fault. That's just the way it is. So overall, that's positive. And you see futures up about 6 points, but we shall see. All right. So Brexit is always hanging over us. We have the bond thing I explained to you. And I can't think of any other immediate risk. The whole special counsel risk is out of the picture for now. It's done. But the recession talk that you hear obviously crimps on earnings, meaning that, companies, if they start to talk about, like, start to mention some things that, things are slowing down. So that obviously flows into some fears that U.S. companies are going to be that the first quarter earnings, which are going to be first quarter will end in a couple of days. So first quarter earnings will be starting to come out in the following month or so. Earnings warnings, earnings announcements, and things like that. Some of them already started putting out the dates. So there's a fear that what if we don't see an improvement? What if the first quarter wasn't the bottom in earnings? Then obviously markets are going to. Then obviously markets are going to go down more going into the second quarter. Not in a straight line, but just overall. All right. That you guys know everything and you're all completely cluelessly intelligent, let's look at some charts here. Any questions on what I talked about right now? None? Okay, that's good. All right. So I'm going to start backwards with the technical charts, just so you guys keep your mind frame. And the reason I show the bigger picture, and we're going to zoom into the micro picture of what happens on an intraday basis, 15-minute basis, 1 hour basis, which we trade very effectively. Actually, you can trade it very effectively off my charts. I did quite a few scalps today on the spies, ending up being on the long side. And so far so good. But the reason I show the bigger picture, so you guys all stay grounded as to what the bigger picture is looking like. And I'm not talking about years and years, I'm talking weeks and months, if not sooner. So here's the biggest picture that I can show you, the one of the widest picture. This should be, sorry. Let's start off with the weekly. So here's your weekly. Yes, there you go. No, let's start off with the monthly, because that's the longest that I can show you, as in zoomed out version, right? Going back to 2009, when all of you lovely people were 10 years younger, and this is where we are. So net, without dissecting it too much, it still looks fine. It still looks good. So even though the algorithmic high-frequency trading black boxes create massive drama, it seems like the world is ending. That's what it feels like sometimes. As traders, you certainly feel it, especially when you're trading options. But when you look at the bigger picture, nothing really changed. Stochastics still moving higher. All the basic technicals that we look at is telling you that we are still on an uptrend. We hit a major resistance level, which I talked about hundreds of times, and there was back and filling. Then there was a rough day on Friday. Nice setback today, collapsing down, scaring the living daylights out of every human trader, and then the market's bounced up nicely. So this is where we are on the monthly picture. So far, no technical damage. Technical damage comes into play at around, if you want to look at it from a more wider perspective, at around 2,700. Now, if we drop to 2,700, that's 600 points from here, 600 to 700 points in Dow. That means the overall trend in the market would have changed, and you can stay short, in my opinion, for a couple of days consistently if we break the 2,700 level. But to get to 2,700, we'd have to drop about 700 points from here. And why do I say that? Is because the uptrending line, which is this red line here, it's the mid Bollinger, is somewhere around that 2,700 level. Okay, so monthly, no change. Still looks like the markets want to break out and head towards at least trying to somehow test the previous highs. That's on the monthly charts. No major technical damage detected. Let's zoom down to the weekly chart. Each of these candles is 1 week. So this was last week. We shot up nicely. We traded it phenomenally. And then there was this inverted hammer. This is what an inverted hammer looks like right there, right? That's a hammer. That's a hammer. That's a hammer. That's a doji, where the body of the candle is in the middle. And you guys got to know this stuff, okay? This is how you trade stocks and you trade the markets. And this is an inverted hammer. It's like a Chinese firecracker falling. You're in the wrong spot, and it's going to come fall right on your head. So you better be wearing a nice New York Yankees cap or whatever you wear, right? Adidas cap or Nike, whatever it may be. It's falling right on top of your head. So generally speaking, that shows that you should be going down further. However, markets are markets. In my opinion, the bulls overall are still in control. Why? I'm not just making it up, but look at this thing. We came down, we tested this line here. This blue line is the 5-week SMA. I look at that very carefully, the 5-week simple moving average. We tested that, we created a hammer, and so far it looks like a hammer. That was today's close. That was today's close. Not bad. Not bad at all. Now, if we had convincingly broken below the mid Bollinger, I would be keen on putting in some nice shorts there. Very nice shorts. Let me ask you guys all a question. You come into the markets are all choppy, Apple's falling $4, things are red. You want to just short. That's the first gut feeling you get as a human trader. If I short, I'm going to make money. If you shorted today, you lost a bunch of money. Bunch of money. Unless you're a fast tactical trader and you shorted the ranges and the levels that I consistently showed on a very accurate level, which we will see on our shorter term intraday charts, the day and swing trading charts. But if you overall came in and shorted the market, you'd be feeling like crap. So what I'm trying to get at is that it doesn't matter what your feelings are, and you go with just prices, well, unless you're looking at these type of charts, unless you're being somewhat of a tactical trader, chart trader, you're going to die. I mean, die in the trading world. You can't short these markets. You think I wouldn't want to short the crap out of the market and make 500% on it? I'm not that stupid. Last I checked, I was a little stupid, but not that stupid about this business. All right. So why don't I do it? Why didn't I just say short, 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 short? Because I could see in my multitude of these very, very precise strategic charts that I share with you guys as much as I can, many, many times during the day. It's a lot of work, I'll tell you that. On days like today, I just want to trade my book to the fullest without having to post a single thing. But I can't because, I'm running a service. And I need to post that. I need to basically show you guys. So I try to show you real-time charts as much as possible. And believe me when I tell you, I'm just sharing this in a nice way. These days, I just would be a robotic trader, completely my own. No reason to tweet anything. Just show one chart in the morning, one chart in the afternoon, one chart at the end of the day. But then you guys would be completely, I mean, you're just like, your brains would be fried. You'd have no clue what the heck's going on. So I put out every hour, I put out 2 or 3 charts so that you guys stay sane. And even then, some people still don't get it. So I don't know how much more I can do. Because honestly, I would love to just trade alone on days like today. And it very profitably. Not that I wouldn't take some hits on a couple of the scalps, but I make a lot back more. And I shared that with you on the stocks that had all the big reversals. So saying all that, you guys need to, like I said, it's time to grow up. So if you look at the weekly chart here, this is, despite this inverted hammer, it is a bull flag. That's the funny part about this business. Everything looks like, oh my God, you listen to the media, we're having a recession. Oh, the Trump rally is dead. He won't cut a deal with the Chinese, blah, blah, blah. All that garbage noise, right? Yet, you look at this chart. What's the big deal? Even this massive sell-off 2 weeks ago reversed completely and then created this. So if you look at this two, if you look, if you look at these two, and this is how your mind becomes very technical. That's the reason I'm spending these strategic webinars, trying to get you guys focused in being a little bit more technical. Some people get it quicker, some people it takes longer, but everyone can get it. Trust me. Just have to try a little bit. So if you look at these two candles, one massively bearish, one massively bullish, and then this. So now this is a bull flag. This is a high-level bull flag. So if you look at the internal, the stochastics, they didn't even budge on the weekly. They're still moving sideways. So if you cut out the daily noise, which is very difficult to do, I should know that. I'm trading daily as well as on the swing trades. So, I'm looking at the markets in a very in-depth level. So I'm obviously being swayed around, back and forth. But if you look at if I didn't have to look at anything on a daily basis, then I looked at this at the end of the day. What's the big deal? What's the big deal? So one part of my brain, and I'm sure it works like that with many of you too. One part of your brain looks at the market like that. Like, okay, there's some real dangerous stuff going on the weekly or monthly? I can't detect any, and charts don't lie. So I can't just make up something. No, it's not. You listen to the media, it's like the world is friggin' falling apart. I don't need to tell you guys that. Hold on. Thank you. So it's still a bull flag. Nothing to see. I mean, there's really nothing to see here. These type of reversals are obviously if you are not quick enough to take some profits, which everyone should be. Because you see, you shooting up big time, and I say always take full or partial profits. How many times have you seen me write that? If I never took full or partial profits and I just rode it, I'd probably have tripled my P&L than what I have it right now. But as a disciplined trader, I sell full or partial profits along the way as it moves along. Just the way I do it. So this is still a bull flag. This is still good, and we are good to go. I can't tell you whether or not this will completely change tomorrow, but I can only tell you what I see now and what the probabilities are of moving higher. I say the probabilities of at least going up towards the level of 28.38, 28.50 are still a very viable move. And you can see that. Now, let's scroll back and look at a daily. This is your daily S&P 500. This is where we are. Now, this looks a little bit more ominous because we have a green doji here, which is not a reversal hammer. It's a green doji. It's in the middle. That means it's an indecision. The daily is telling you that this large sell-off that we incurred on the 22nd, which was on Friday, did some not major, somewhere in the middle between major and minor damage to the short-term picture in the market. So that we have to be cognizant about. And so this doji has to expand and take out this Berlin Wall that I talked about for so many weeks, so many months. This one that we broke above ferociously before we gave in again. We should at least capture the 28.18, 28.19 level on the S&P 500 because that's the big wall, right? This is where everything failed. So now I talked about the fact that you're going to have back and fill. So if you want to look at it simplistically, if you hit this huge wall that has 4 major attempts of breakout and it didn't, and the 5th attempt it broke out, and I told you that it would, and it did, came back and retested, went up again. You can pretty much looking at it simplistically. You hit this massive resistance going back to October of last year. You are going to have a back and fill. So that's exactly what you're getting. Now the 6th try better break out, because if it constantly keeps on failing, that means this wall is getting stronger and stronger. They are unable to break the 28.18, 28.20 level. So just keep that in mind. We need to stay above and across the top of this Berlin Wall right there. It's that simple. So the daily has to be watched. The weekly and monthly picture is saying across the horizon, things are okay, but the daily could slip and slide, and obviously the major ultimate support is at 27.25. That's roughly from where we closed at right now, about 60 points, 70 points. So 70, this is 70 S&P handles, 70 SPX. That means it's roughly about, what is it, 500? Yeah, I would say 500 Dow points that we could possibly drop if we break below where we are, what the low was today. And that could happen for a myriad of reasons. Could be Brexit, could be bad, a couple of bad news flow out of the US-China trade talks, and bingo, we could slip. Bond market shenanigans that I explained to you, any of these factors could drop us. So we have to be careful. Which brings me to a point. When things get really choppy and volatile, whether it's tight range, as we're going to see, what happened today was very tight range for volatility. It wasn't 700 points up and down that we have gone through before. Okay, some of you might remember, some of you don't. Or if you don't, then you really need to get checked, because we went through quite a few of those within the past year, especially in 2018. So the key, one of the simplest way that you can reduce your mental stress as a trader is to reduce your exposure. You don't need to get out and look for, oh, we're going to be down 500 and boom, you short really hard. Then you lose all your money because the short doesn't work. If you have 3 contracts on something, if you have 10 contracts or something, reduce it down to 4. Minimize the volatility in your own P&L. That's the simplest way of doing it. I do it. If I have 6 calls in something, I'll bring it down to 2. If it starts to turn and start running, I will re-add it back up depending on my charts. But to minimize the volatility, the implied volatility within your own portfolio of different things that you own, just reduce the number of calls. Generally, I'm recommending calls based on the level we are right now, and overall, I've been dead right on it. So, uh, so that's it. Minimize the number of calls. And if the market shoots up 600 points, and you're like, oh man, I should have held all of them, which has happened many times. Well, at least you minimize the volatility. You can always jump back in. But if the market goes down 500 points, you're not stuck with 6 calls going the other way and looking to dollar cost average, and it doesn't feel good. So that's the simplest strategy I can give you. You put stop losses on options, you get taken out like, I can't even find an analogy for it. Okay? You get taken out like a drunken sailor in a Nigerian port. I mean, how about that? Because once you get taken out, you ain't coming back. So, some Nigerians going to be, oh my God, why is he talking to me like that? No, I'm not. Let's say any other wild port, where they go crazy. So the thing is that you got to be careful. And the only way you got to be careful is not to be completely out of the market, but minimize your position sizes so that you can deal with the volatility. And don't get too excited because something's running up 50, 60, 70 points, because as we will look at the next charts, that can give back within the next 15 minutes. And you're like, what? So I'm not surprised by anything. I get angry when I see these algos at work every 15 minutes to an hour, back and forth, and I've shown multiple charts on that, where pretty much, what happened today, the box, and this one, for example, this is pretty much what happened today. And it drove the world nuts, drove CNBC nuts, all the financial channels nuts. They're all trying to find out a way. All the algos did chop, chop, chop within a very tight range between SPY 280, 21, and 277, 21. In the case of the S&P 500, it was 2809 and 2785. That was freaking 24 S&P points. That's it. And that's all. This was today. Like I wrote in simple English, this is what Algo HFT Black Box program did all day today. See, when you look at the markets in this type of fashion, like in a very militarist, like military style reconnaissance, right? You're looking at it, you're boxing it. You know exactly then where you need to get the heck out of Dodge and where you can stay stable, cost average, or do what you need to do, where you don't need to panic. That's the reason why you need to be a tactical chart trader. Because you're selling something and then it running up against you, which has happened to more people than anyone will ever care to admit. All of you have been guilty of that. You have lost more money by not being in trades which have shot through the roof than holding something that has come down and then bounced again. And that's a fact. It is. You can't lie to yourself, You can lie to the world, but you can't lie to yourself. Some people try to lie to themselves. It doesn't work. So the thing is, this is what we did today. And every candle looked like, oh my God, here we go again. And then, boom, next hour. Remember, it's an hourly. First hour, second hour, third hour, fourth hour, fifth hour, sixth, seventh hour. I think where do you start here? 1, 2, 3, 4, 5, 6, 7, 8. So, right, starting here where the market started. That's all we did. Now, internals, as all this chop was going on, the slow stochastics found a nice base and they kept on moving higher. And that's good. Told you that the real players were buying, and the real emotional traders, specifically human traders or jumpy price watching traders or all your stock twits buddies and all your other services that you follow, they're all jumping around like the end of the world story. Okay, everything's going to fall apart, markets are going to be down 10,000 points. They have no idea why they're saying it, because they're just saying it. They don't even understand what Brexit is. They probably think it's some sort of English toffee. Okay, no pun intended or insulting that to anyone, but it's true. So bottom line is the internals kept on creating a nice move higher, which is good. As a tactical trader, whatever you bought at these levels, you can dump when the markets open, gap open tomorrow, and it looks like they are going to gap open. Futures are up 8. Barring any other major Globex overnight sensational stuff, the markets are going to gap open, and you can take yourself a nice profit. I know I will. Next. This is your daily version of your S&P 500 futures. Nice reversal hammer off the 34-day moving average, almost, not quite there yet, and all kinds of stuff. Please look at my Twitter feed. So this being futures, it's a little bit more choppier than looking at an S&P 500 chart, because futures are the most liquid version of the actual S&P 500 ETF, the SPY, or the SPX, the index. Now, let's get into the nitty-gritty of it, okay? This is the trader's paradise. Mommy, are we there yet? Mommy, can you change my diaper? Mommy, I need new diapers. Well, this is this chart, right? So, before I go any further, let me just explain one thing to you. By now, all of you, if you're still trying to make head or tail reason why one day the markets are up 300 and the next day they're down 400, and you are still not following the charts, you need to really get into like a mental institution for traders. I'm dead serious, okay? Like Alcoholics Anonymous, like Traders Anonymous, because this is the market. Don't always try to make rhyme or reasons why something is going on, because it's not going to give you a reason. There will be a bond yield inversion reason. There will be a Brexit reason. There will be a tweet reason coming out of President Trump. There will be a China reason. There will be this, that. That's just the noise. You got to trade the charts. So this is a 1-hour chart. And as you can clearly see, the bottom, a definitive bottom, was put in on March 8th at 27.20. We identified it. We moved up in a very choppy algorithmic high frequency trading fashion, like it always does, within this uptrend channel, which broke, tried to re-enter, broke, big, hundreds of points higher, big money, people are happy. Then Friday, big collapse, pull up, and this is today. And this is the way markets are. So get used to it, but just don't be a trader. How about that? And I'm not discouraging anyone to be a trader. I want to enthuse people. I want to encourage people. I think everybody should be a trader of some fashion, you know? But most people are so scared of the market, very intelligent people, they would never even put 10 cents, and they might have 10 million in the bank, but they won't put $100 towards the option. So it's good, because we are the chosen few when it comes to the trading side, and more so here at Clueless A Trading, we are the chosen few because we truly have developed a fantastic approach to the markets through these tactical way of looking at it. And many of you have caught on to it very nicely. Some of you are trying, some of you hopefully should be trying. So that's it. So that if you look at the 1-hour chart here, it's all about overbought, oversold. But I did this sine wave here, and let's see. We were in this channel. We fell below that. Now we should attempt to get back in it. And of course, along the way, each of these lines, the market is going to hit, and the market is going to sell there. Whether it's a full-scale sell-off, whether it's a minor sell-off, that's for the algos to determine, and that's for me to show every hour, every 15 minutes. And that's for you to handle your money. So if you're trading SPYs and such, these are the ultimate charts you could ever use. No questions asked. And it is choppy. So this is the face of true volatility. This is the face of machine language. This is the face of algorithmic high frequency trading. And yesterday I put out a chart saying there are no patterns. And honestly, what is this pattern? One can say it's a slanted W. One can say it's a head and shoulder, head, right shoulder, left shoulder, right shoulder. I'll go with that. That's a head. That's a left shoulder. And if the market has a big rally, it's going to hit a road bump at 28.59, 28.60 on the E-minis, the futures, because that's the right shoulder. So I'll go with that. Or you can look at it as a complex slanted W like this. Sure. Why not? But I know at least what the levels, if I'm up nicely, instead of getting super excited, I'll go ahead and dump those calls, those cheap SPY calls that go from 50 cents to $1.50 to $2 at each of these resistance levels, um, depending on how they're forming. Let's zoom in more at the 15-minute chart. This is truly a mathematical wonder. Look at this friggin' chart. Any of you can read this. Anybody. If anybody tells me they can read this, I can certainly help them, and it would be shocking if you say you can read this chart. Throughout the day, the algo is basically effed around. Can use the F word, right? What do you call? And this is what it did all day, just the way I showed you here. This, oops, is the same as this. This is just what it did. Did it change anything? No. Did it drive people nuts? Yeah. That's algos. Okay. Now, so the more you grasp these things, the better off you'll be as a trader. No question about it. I am. If I can do it, anybody can do it. Trust me. All right. And this is where we are. If we break this level, there's a big red arrow. You don't need to ask me. Go short the friggin' market. If it breaks through 27.84, there's going to be a flurry of selling, which will replicate this flurry of buying, and we're going to fall to the 27.50 level. You got to be quick on the trigger, and somewhere along the way here, it might suddenly turn around and go up. So get prepared for that. That's why I say it. Active traders, you got to be quick. If you're not quick, then don't bother. If you're not quick, don't bother shorting. Specifically shorting. You want to short this market at extreme high internal readings on many fronts. McLaren oscillators, the trend reading, and other oversold readings and such that I look at, stochastics, then you got to be quick, or else you're going to get your pants and whatever else that they're burned, just the way many shorts did today as the markets ended in the green. And this is what the markets are doing right now. This is live. And this is what the markets did today. So net, when I look at this chart here, my gut tells me, this is the 15-minute chart. Oh, this is our chart too. That again, this is the box. That's why I have this yellow shaded area here. Upper end of the box is 28.26. The lower end of the box is roughly around 2,800, 27.91. So once it hits the 28.30 level, which is which is a good 70 to 80 points on the Dow from the opening, you're going to hit. The sell programs are going to go to, the sell programs are going to hit again. So that's how you're going to trade this. Trade the box. And you can make a decent sum every single day if you trade the levels, even with small amounts. And if you're bold, then you can buy big chunks and trade them for 15 minutes and feel like a frigging trading god because you made yourself some real decent money in 15 minutes to an hour. You can do that too, but you got to be glued to these type of charts. Final chart is another classic creation here at Clueless A Trading. This is a Fibonacci retracement. Here's your Fibonacci retracement. How many times have I said that if you have an impulse sell-off, these waterfall type of sell-offs, and I even put the reasons at the bottom, that it generally tends to bounce back to the 50% retracement. You don't need to be a rocket science. We'll probably be there at the opening tomorrow. What happens at the 50% retracement? Resistance again. I would love to lie like many other services do, and put out like, oh yeah, if it gets here, it's definitely gonna get up here, and yeah, you've breached this level. Garbage. Most services lie. Why do they lie? Because they want to keep their people happy. Well, I'm not in the business of keeping you guys happy. I'm in the business of delivering the ROI performance so that you can make yourself happy. But I'm going to give you the actual reality of what happens in a technical market. So I don't know if this is going to get up towards 2850 or try to re-enter this consolidation channels that it broke. Remember, this is the consolidation channels, right? 1, 2, 3. Whether or not it's going to re-enter that and go above that, I don't know that yet. But I do know that that's a very high probability that if you bought somewhere here today, you are a very happy camper even by the end of the day. A little bit of a happy camper by the end of the day. And you'll be a very happy camper when it hits that 2828 level, because your net entry would have been in the 2800 level. You make 30 points on the SPYs, on the S&P 500, and roughly 2 to 3 points on the SPYs. You're golden. That's how you got to think. If you think the market is going to completely reverse and go all the way higher, well, yeah, if you look at the weekly and the monthly, there's no technical damage. I can make a case like it's going to go there, but I can't tell you that on a short-term basis. So Clueless trading is not about lying and making up fake stories just to keep you guys happy. This is the reality, how you can make chunks of good money during volatile periods. We are the masters of trading volatile markets. We are. So that's pretty much the overall story with the markets right now. The VIX charts are all there. Kindly follow them. They are the most reliable indicators, in my opinion. The VIX, during extreme duress in the markets, I'm always looking at the VIX anyway. It's always on one of my screens, I keep on showing it to you guys as much as I can. This is your VIX. This is not necessarily a good-looking chart. The VIX kept on attempting to move higher, pushing the market down. Some of you are like, oh my God, look at this. I kept on looking at the slow stochastics. They kept on sliding down even as the VIX. One candle on the VIX like this means the market dropped 50 points. Went up. Then these sell programs came in. But in the meantime, this was telling you from not the start, but from the lows in the market today, pretty much, that this is a triple top. And this was telling you, the slow stochastics, that the market would end up higher. So almost easy if you think about it. But in the meantime, each of these candles, they're 1 hour candles. Let me make this bigger. That's better. Okay, 1 hour candles clearly tell me. And this, I use the quad system, the bar chart, one of the best platforms. I always push it. You guys should definitely use it. Anyone who wants any information on it, I'll send them the email. They can directly call them, get a free trial, and move from there. Unbelievable. I can pretty much tell you what the market's going to do on an hourly basis, but just looking at the VIX, which I already do. If I see large candles coming in, doesn't matter whether the market's kind of sitting pat, it's going to move higher, and it does. Why? Because it's all directly correlated. These are machine programs which are basically running pair trades with volatility indices, the VIX being one of them, and the front end of the market, the S&P 500. So when S&P 500 is a green candle, the VIX has a red candle. It's not rocket science. But they do move fast. They are annoying to watch. Who wants to watch for an hour whether or not this candle develops? Well, you kind of get used to it. All right. On that note, let's look at a couple of stocks. So somebody throw me one. Okay, I will first start off myself by, I like Boeing a lot. It's been pretty consistent overall winner. I don't go with opinions, whether there's bad news coming, some, members, and you all have to go with your gut feelings. I look at Boeing on a very, very technical basis. I'm not married to it. I will trade it intraday. I will hold it for a couple of days or so, depending on how much time I'm buying. This was Boeing today, 25th. Hit a low pre-market of 362 on lower, ended the day at 367. Boeing from top to bottom today was up. And just to give you an example, why example? You guys should know it because I posted it so many times. You could have bought the calls as much as you want in the 40 to 50 cent range. They closed at close to $1. Somebody's giving you 100%. And some of you are just sitting there saying, no, Boeing's going to go lower. Okay, great. All right. When you can trade 40 cents call and they close at 95 cents to $1, why the heck are you guys not doing it? It's like buying a $4 call, which goes to 10, which we did with Amazon, by the way. So it doesn't matter what the market's doing. You can play these reversal trades. For a couple of these scalps, you're already green for the day, despite the fact you could be red on a couple of the swing trades. So Boeing's great. The Boeing 375 calls, I was looking at the 380 and 385. Those are the ones I was trading. But even the 375 calls went from $1.67. Let's say you caught it at 2, closed at the high of the day at 350. So you bought it at 2, 350. What more could you ask for? You made 75% on your money. So again, can't teach kids, how to use the potty, but ones who do want to learn, we call them potty trained, right? So try to get potty trained, guys, instead of always grabbing diapers. So Boeing has a box here. That's where it's going. Once it hits this box, we'll see how it reacts. I traded Boeing in a purely technical level. Boeing had the worst news of the day. Stock still went up. Boeing had negative news that Ethiopian Airlines, which was one of the largest buying, that's unfortunately their plane was the one that crashed, said that Boeing should have those safety mechanisms, the extra ones that they didn't pay for already as a default. Okay, why does the stock go up $8? So you can't always go with what's in there. If everybody knows the same story, then what's so special about you? Like this, you always have to act a little bit contrarian, but you also have to look at the charts. So this is, this is a technical chart. I can clearly see what's going on. Each of these candles are worth money. And of course, it's volatile. But by the time it's safe, Boeing is going to be $400 again. What are you going to do? Buy it there? So just give me a stock if anyone wants to see it, or else I'm going to wrap up. No one? None of you are stock traders? Great. That's exciting. I love it because that shows that the market has a lot of room to go higher. And I mean that. Okay. So it looks like no one has any stock because I have a lot of great stock charts on Twitter feed. So feel free to check those. But one thing I will tell you on a parting note, the apathy and the despondency of the average retail traders that can be seen even in this session, even though you guys listened very carefully, no one was even excited enough to ask a particular stock or whatever, shows that there is no euphoria whatsoever in the market. It is fuel for further market gains, period. It has always been like that throughout financial history. It will never change. By the time everybody's super excited, throwing out 30 names on 30 stocks they want to see, market is severely overbought and we're in for a large collapse. On that great note of behavioral finance, have a great week. God bless you all. Stay engaged and make some money. Good night.